So for some calm advice on where to find value, here's Robert Quinn. He's head of European equity strategy at Standard & Poor's. Robert, thank you so much for coming in. All right, so it has been pretty violent and it's been a real roller coaster, but what makes you believe that this has been oversold?
I would probably try and balance it out by saying it has been extremely brutal, the sell-off we've had recently, especially some of the intraday moves that we've seen, which hasn't necessarily been captured on the end of day readings. But then so you have got some oversold opportunities. The flip side of that is it will take an awful lot of heavy lifting to generate some positive sentiment at the moment. What you've got now is that you've had a movement for the chapters. You've had a transitory mid-cycle slowdown, if you like, in February and March. That transformed into a lot of kind of sovereign stresses again. This time, and this summer, has been led, the sell-off's been led by equities. Yeah. Before you had, like, for example, you had a very nice connect between European banks' relative performance versus peripheral kind of CDF spreads. But that's now disconnected.
But we also seem to understand that actually over the last 4 or 5 months, a lot of the hedge funds, a lot of the equity strategists were putting positions because they thought the economy was much stronger than it actually turned out to be. And so there was a huge unwinding end of July and in August. Are you expecting this kind of unwinding or, just fear on the market to continue over the next couple of months until we have a kind of a shock and awe? We talk about these shock and awe packages, but at least something that just gives the confidence that the economy is back on track.
Yeah, there's a clear lack of a positive catalyst right now. For some of the hedge funds we speak to, by the way, to your earlier comment, a lot of those have taken their positions down to zero beginning of the summer. So, a lot of that was forced proprietary banks selling off as opposed to more long-term institutional investors. There is a real lack of catalysts out there. You wonder, the market knows that the effectiveness now of any further monetary or fiscal response is negligible. You could say people would want QE3, the Jackson Hole speech by Bernanke in 2 weekends' time. A lot of people will be watching that, but then you could say, what was the success of QE2? Yeah. So you wonder what it will be. We are in a definite growth scare now. The worst performing markets are Germany and Sweden, not necessarily Ireland or Portugal or even Greece.
And so are you expecting a recession for this year? Yeah, absolutely. The German GDP figures were a real eye-opener because it's also the core of Europe that's struggling. Are we going to see a recession worldwide, and what will that mean for your equity strategists?
There is a historical precedent. If the US is in below 1.6% year-on-year growth right now in the second quarter. Normally, if it goes below 2%, that does lead into a recession within a short period. There's a lot of indicators that are pushing that way. Most of the slowdown in manufacturing, which is obviously more volatile than the servicing sectors, have been weakest in the UK, in the US, in Germany, the areas where there wasn't so much stress, if you like, in those economies on a fiscal standpoint. So you have seen a lot of the stronger economies fall back. Will there be a recession? Quite possibly. I think if there was one, though, it would be mild compared to the credit meltdown of 2008, 2009, and even 2001, 2003 equity market sell-off. Equity markets aren't very expensively valued, 8.4 times.
Valuations do seem pretty cheap, but I guess it depends on how much risk you want and actually also the sectors that you're going for. So are there any particular good deals out there for investors with a strong stomach to be had?
You need a very strong stomach. If you try and convince someone to buy in some of the bank shares, you probably put the phone down on you. But what I'd probably recommend, I can't see any strong uplift in the minute. What you've basically in now is a fragile business cycles, and that will be the case for the next cycle and possibly the third cycle after that. So you're not going to see equities re-rate until anything mid-teens for a long time.
But so if you wait a couple of weeks and there's still a little bit of sell-off, is that a good buying opportunity?
Catching the knife, I'd probably recommend, for market neutral approach, you could take a long in some stocks such as BMW had its best set of results in the second quarter it's ever had. A lot of companies didn't have great Q2 results, but they did. On about 7.5 times next 12 months. You could short that with Peugeot, which is very low revenue growth prospects. At the same time, you could go long on something like Rio, where the supply fundamentals in miners are tight for a few years. You can cover that with something like Salzgitter and the steel manufacturers.
How do you stock pick? Do you look at management? Do you look at valuations, or do you look more at also growth strategy? So if they're in the emerging markets or if they're commodities, then that's a good play because it's going to grow much more than here in Europe and the US.
It is. That would be in a more calm markets. At the moment, whether they're strong management or not, hasn't had much impact in the last 6 weeks. Everything's sold off. You've seen utility stocks smashed. You've seen IT stocks smashed. It's been very indiscriminate, which is why I think, even though everything's telling me for an easy interview to say just sell everything, I do think there's some sort of kind of stabilisation ahead.
Yeah, so stay put for now. Yeah. Rob, thank you so much. Robert Quinn there.